So there's this guy named Ken. Ken is one lucky fella. He's been blessed with the opportunity to be with a wonderful woman by the name of Rachel. Rachel is beautiful, Rachel is kind, but to Ken, best of all, Rachel cooks. And when I say Rachel cooks, I mean she cooks everything from healthy meals. She can make a poke salad. She can fix up a steak, slice the ribeye, make it medium, perfect, juicy, appealing to the eyes, and wonderful to the taste. She can even consistently deliver the avocado toast so many people this day and age love. When I say Rachel cooks, I mean Rachel be cooking. Based on this, Ken had the idea that Rachel should probably open up a restaurant. He loves her cooking, and he figured everyone would love her cooking. They talked about it. Rachel agreed, and she went into business. She opened up a restaurant and called it Herbs and Spices. Herbs and Spices started blowing up. Ken was right. Everybody loved Rachel's cooking. The restaurant got great reviews and people were lined up. They were out of the door. Usually, restaurants take a while to turn a profit. But herbs and spices, it made money instantly. It was all the rage throughout the region. Everybody was talking about it, traveling to come to the restaurant. Man, Rachel realized quickly that she probably would need additional locations. However, this potential growth came with some challenges. Rachel knew that basically she had two options when it came to growing her restaurant, expanding the business that is herbs and spices. One, she could choose to borrow a huge amount of money from a bank, pay it back with interest, and have the loan be a liability that's ongoing as a business expense. She thought about this, but the type of growth she required, it would take a huge loan. This really wasn't her cup of tea. The other option was to find financiers that believed in her restaurant and wanted to be a part of a growing business and were willing to help raise capital to invest in the business. This option, after much consternation, is the one Rachel decided to go with. So she took her restaurant public and decided to use investor dollars to help grow her business, despite the fact that she knew she would have to give up some degree of ownership and control in the process. Well, she consulted with an investment bank. They told her how much they believe her business would be worth. Based on that amount, they produced a number of parts, which we call shares, that would be sold to potential investors. And they talked about what's called the initial price that investors would pay for the shares. That's the IPO or initial. Well, I'll get to that in a second. Now, Rachel and the investment bankers, they agreed. And the bank paid Rachel for the shares based on the dollar amount they agreed upon. And then the bank took possession of the shares and went about the business of drumming up interest in getting accredited, qualified investors on board to buy Rachel's soon to be released shares that they possess now. They did tons of marketing. And after lots of hyping up the shares of herbs and spices, they found a line of investors ready to pay money to get in on the offering. Once that happened, the accredited investors bought shares, and those investors gained partial ownership in Rachel's restaurant. Once this happened, those investors said, "Hey, this is a growing business. I want my money to grow." So they took their shares, and they resold them on a stock exchange with the hopes of making a profit and having more money than what they spent on the shares paid back to them in exchange for the shares on the open market. Rachel's little business is gone public, folks. And now that that is the case, anyone that trades on an exchange where herbs and spices is listed can buy shares and own a piece of the business. That's you and me, folks. The more demand there is for shares, the more the cost to buy those shares would be. So if you already own those shares, great. That's increasing value for you. For instance, you pay $10 for a share of herbs and spices. Everybody's trying to get in on it now. So much so that demand has caused the price to increase to $13. If you sell your shares for $13, you make a 30% return. Winner, winner, chicken dinner. So everyone now has a seat at the table. So congratulations, share owner. If you bought into herbs and spices, you can participate in the profits of the company, and you even get to the right to vote on issues ranging from who will be the president, who the board of directors is, things of that nature. So, bravo to you. So, we use this illustration to try to get you some background on how a company goes from being a company to being a public company that has stock available for you and I to buy and sell. Now, what a stock is, it's basically an asset that represents the ownership of a fraction of a corporation. The owner of shares of stock is entitled to a proportion of the corporation's assets and profits equal to how much stock they own in proportion, of course, to the total stock available. If you have further questions, again, we'll get into this a little more deeply in Mr. Darsten's Money Management Made Simple. But I wanted to have a quick dive into what a stock is, how a company goes public and begins offering stock, and how you can get in on that. Thank you for your time. I hope this has been enlightening. Have a wonderful day.